I'm not surprised this has happened because we published a note yesterday saying this is a Band-Aid, right? This is not a cure
Band-Aid. Okay.
for the situation we are in. Look, even if you plot the amount of buybacks relative to the amount of hyperscaler issuance in the offing, look at the net supply in the offing, you need a magnifying glass to identify the impact of these buybacks, right? And then, of course, you aren't even controlling the more critical issues of deficits, of Fed credibility, of the fact that the AI build-out is a massive growth engine for the economy. All those factors are the main drivers. A small Band-Aid won't fix it.
So those things you mentioned, the AI, the Fed uncertainty, is that just lifting global rates? Are we in this higher for longer? Is this something we need to get comfortable with as a market?
Yeah, look, I think that's exactly right. So I think one crucial point here is 5.25 on the long bond, I don't think is restrictive. I think it is just a normal rate level for the kind of growth environment we find ourselves in, kind of inflation environment we find ourselves in. If you look at the performance of the stock market, look at small caps versus overall stocks, look at the S&P equal weight, all those stock market numbers are going up despite a world of high rates. And what that tells you is markets telling us the growth numbers are so good that they're going to outweigh the impact of high rates. That's why these stock numbers are up.
All I know is I'm not refinancing the mortgage on the Jersey Shore compound here. What do you expect to hear from out west next week with all those muckety-mucks, including Tom Keene out there?
Yeah, look, I mean, I don't bring good news for you on the mortgage front. I think that's been a constant feature of our conversations. I think rates are still going to keep going up. The Fed's going to be challenged. The Treasury is going to be challenged. The next event, of course, is Jackson Hole, where people are going to focus on whether the Fed is going to do something about credibility. And this is the challenge with the Fed as well, is darned if they hike, darned if they don't, right? If they do address the credibility issue, they will have to do more rate hikes than they had planned before July meeting. So I think they had planned for or the market thought they would do 2. I think the market now needs 3 or 4 to give them the credibility back. Alternatively, if they don't do anything and let the markets do their own thing, then the long end keeps selling off anyway. So darned if they hike, darned if they don't.
But I think just yesterday's activity from the Treasury Department suggests that this administration is sensitive to interest rates. I'm sure Mr. Trump's real estate friends are, calling him up saying, hey, you got to get rates down here. I'm trying to get some deals done here. How does that all work out, do you think?
Yeah, look, I think you can't fight the fundamentals. You can technically, make some supply-demand conditions for the short term. This has been tried before with the yen. This has been tried before in bond markets in UK and Japan. In a world where the fundamentals are as strong as they are, it's very hard to just take down $2 billion per month of supply to fix the issue.
Guneet Dhingra with us with BNP Paribas, the giant of Paris, France. So you're in the tourist area. You go up to Opera, and our offices are right there.
Right there. I love
Street.
the BNP.
And you turn right on Italian. You go down, and there's the Guneet Dhingra building. 20 Boulevard des Italiens.
Oh, nice.
The French yield is a mess. Like yesterday, Japan, lower yield off the Besset moment. France, like a rock, didn't move. Can you brief us what you're hearing from your BNP Paribas experts about the fragility of debt in France?
Yeah, look, I think the issues with fiscal situation are global, as you said. Japan, France, US, every country is dealing with them. In Europe, obviously the ECB matters too, and we think the ECB is going to hike in September one more time.
Hike one more time.
That's pretty well understood. I think the ECB goes on hold thereafter. So that does kind of keep the European bond market a little bit more stability compared to all the fun in the US.
Here in the US, we have a steepening curve here. What's that telling us now? I understand this stuff, but Lisa Bromwich just wrote in and says I have to ask that question. Steepening yield curve, what does that mean?
Yeah, so I call this a K-shaped bond market.
K-shaped
right?
bond market.
If you look at what happened since the July FOMC, 2-year yields are down, 30-year yields are up. That's a K, right? So different parts of the market have a different reaction. I think the steepening also has completely reversed the entire flattening we saw post the June FOMC, where the market assigned a lot of credibility to the Fed. The steepening recently is a combination of that credibility has been wiped off, plus, of course, the massive hyperscaler issuance. Plus, I think people are starting to notice that the interest burden and the tax receipts are not keeping up, and deficits are ballooning again.
Guneet's here, Paul, so I'm rocking the fancy mathematics on the terminal.
Yep.
And unit is so much. If you look at a daily chart, if you're trading a 5-minute chart, some fancy hedge fund dude, or you look at a weekly chart, which is sort of the convention of longer term perspective. Guneet, right now on a weekly chart, it's like the Besant move didn't happen. We're out at a higher 30-year yield.
Absolutely.
Just on a weekly chart. I didn't know that till just now.
Yeah,
that's
look,
amazing.
I expected this to be faded eventually. I thought this was going to be a speed bump, and maybe through September 9th, when the buybacks actually happen, or the new buybacks happen, people might wait to fade this. But I'm actually impressed at how quickly this has been faded. That just tells you the markets have realized that this is not going to do much in the overall context.
All right, Tom, on the Bloomberg terminal, all you have to do is type in U.S. debt, and it gives you the U.S. Treasury total public debt outstanding, 40 trillion, which we've been reporting.
Tipped yesterday.
Look at the graph from the last gajillion. It's just straight up and to the right. At what point, I've been asking the same question, Tom, since I started on Wall Street in 1986. At what point does our U.S. debt become a problem?
Look, I think I wish there was a magic number of debt to GDP of 100%, 120%. I don't know the number. I think what's pretty clear is the interest burden continues to go up, and markets can't look the other way. I think that dynamic has changed.
I just don't know.
I mean, Sweeney is a font of wisdom, folks. I didn't look at that. I just took it logarithmic, and there's a big spike up. Call it. Let me get right there. There's a big COVID spike up. Slope matter. Brian Sullivan over at the Death Star taught me this.
Okay.
Slope matters.
Okay.
Okay. So I got a big COVID slope of increased debt, and what's important, as you say, Paul, from 2022, folks, Guneet, it's linear. I mean, it's not a jump condition here. It's just growing.
Yep. So I think what happened last year, for example, is we had the tariff revenue come in.
Yep.
And people were calmed about hey, we are now controlling this thing.
Yeah.
Tariff revenues are coming in. The spending in the discretionary stuff has gone down.
Right.
So it looked controlled, but all that stuff has reversed and then some. Interest burden's high. Tariff revenues have turned negative because of the refunds. And I think people are starting to realize as the midterms come closer, the discussion on the defense spending is going to ramp up.